Okay, let's talk about China. What's going on in China? Why is China all over the headlines? What's been going on since 2015, even earlier? Why is their market tanking? And why are all of the big institutions loading up at the bottom? Well, you already know the answer to that question. Let's go ahead and go through this real quick. I'm going to introduce you to China's basically their growth transformation that they're undergoing and that they're about to be completed with. So basically, China is undergoing a welcome by the industry, by the way. It's welcome, but it's rocky. And what they're doing is they're going from an economy driven by investment and exports to one in which private consumption and services are the major factor in economic expansion. This is huge. Several roadblocks stand in the way of achieving this objective, which are, and by the way, I'm quoting a document from 2015, and the roadblocks that are going to be in the way that have already came to fruition, which they told us about all the way back in 2015, are a potentially slowing economy stemming from rising debt levels, which we already see, and a languishing real estate market, which, again, we've already seen. So someone needs to go tell this guy that his whole narrative is incorrect. He needs to read the documents, and sorry, buddy, but you're wrong. I'm about to show you why. Again. So to make progress on these and other issues, China would be well advised to conclude new agreements on trade and investment with the United States and other economic partners, and to further open up its capital account and develop its financial markets. As the recent turmoil in global markets suggests, the problems facing China affect the global economy in ways that are more far-reaching than ever. And by the way, the collection of essays in this video are by scholars at the Peterson Institute for International Economics, PIIE, and part of a series of interactions and discussions with the China Finance 40, or CF40 Forum, which began in 2012 along with the rest of this. The papers are intended to illuminate the challenges facing China as it engages increasingly with the global economy and builds on its phenomenal economic success of the past 3 decades. So the standing narrative, the dominant narrative on the Chinese economy now has 2 components. The first is that data on economic performance are falsified or erroneous, and that the slowdown is worse than previously thought, with growth possibly at only 4%, far below the officially claimed 7% pace of the first half of 2015. Second is, part of the dominant narrative is that further weakening is likely, and that because of China's large global economic role, this further weakening could trigger a global recession. Feeding this narrative is weak industrial growth, 6.3% in the first 8 months of 2015 compared with the same period in 2014, continuing the softest stretch in 15 years, and electric power output growth of only 0.5% in the first 8 months, probably an all-time low. Now, these pessimistic assessments, however, failed to take into account that for the past 3 years, between 2012 and 2015, services, rather than industry, have been the main driver of China's growth. By 2014, services accounted for 48% of China's gross domestic product, substantially larger than the share of industry, which accounted for only 36% of GDP the same year. According to official data, in the first half of 2015, value added in the service sector grew by 8.4%, accounting for 4 percentage points of China's 7% growth. Now, let's talk about job growth. Because they're moving away from industry and are going into services, services are much more labor intensive than industry. Thus, the rising demand for services in turn has accelerated job creation in the modern sector. A 1% increase in industrial output creates 500,000 jobs, while a 1% increase in service output creates 1,000,000 jobs. So they're literally doubling the output of job creation at the same time. Thus, the number of non-agricultural jobs created in the past few years is actually greater than when the economy was growing at double-digit rates but led by the capital-intensive industrial sector. China created 7.18 million non-agricultural jobs in the first half of 2015, which was a record at the time. Now, effects of non-agricultural job creation. The increased rate of creation of non-agricultural jobs has a twofold effect on the wage share of GDP. First, wages in non-agricultural jobs are about 3 times the earnings in agriculture. Thus, as the share of the workforce employed outside of the agricultural rises, other things being equal, the wage share of GDP will rise. Second, more rapid growth of demand for non-agricultural labor has meant that urban wage growth has remained strong even as the headline GDP growth number has slowed since 2010. It should also be noted, and this is important, that services are much less energy intensive than industry. Industry requires 8 times more energy per unit of GDP than services do. And roughly 2/3 of the industry is heavy industry. Ferrous and non-ferrous metals, heavy machinery, etc., where the amount of electricity required to produce a unit of GDP is 10 times that required in services. So since the structure of production is shifting from heavy industry to services, the famous LI something index of GDP growth, which has electricity as one of the 3 components, another is railroad, and then they also have freight transport, is now outdated and no longer a reliable guide to the pace of expansion of China's economy. So for those of you using this index, stop doing it. It's irrelevant. Now, since you know that China has been undergoing a very large transformation that is welcomed by the rest of the world, but the rest of the world understood it was going to be a rocky transition, now you can understand and see what exactly we've been going through. Now, what was COVID? Was that to help with the transition? Don't know. But all I know is that this all ties in together. Those of you claiming that China is going to crash or there's going to be a recession, global economy, not yet. Not yet. That's going to happen on the US side, but next year. So, again, pay attention to who you're following. There's information out there that you can learn, and you can learn reality. Or you can be led into the dark with a blindfold on by all of these people you claim are heroes, when in reality, they have nothing to offer society, and without you wasting all your time watching them, they'd be unemployed. So again, China is a insane opportunity. You can now see the supply chain issue is stemming from China's transformation in and of itself, because if you have the biggest exporting economy on the planet moving away from exporting, what does that put in the US's deck of cards? Well, it puts production, which requires infrastructure. So now you can see all these political macroeconomic events, like the infrastructure bill, it's for China. It always has been. The world is building up China because they need to. It's a global economic stabilization process. There is no doom. There is no gloom. They're building the future, and it's happening soon. You heard it here. I've been saying it this whole time, and I know I'm right because I've read it. They tell you. So buckle up, everyone.